Morning, everyone. Welcome to this morning's edition of MPC Markets Morning Call, 12th of September, 2025. So the bulls were unleashed on Wall Street again last night. Stocks hit fresh record highs as CPI numbers came in at, as expected, at 2.9 year on year, slightly higher than expected for the monthly number, which was the highest since January. But despite that sort of small uptick in inflation, that year-on-year number remains largely the same. And analysts and investors very much focusing on the fact that the weakening labour market probably outranks the inflation numbers at the moment. While there'll certainly be some Fed concerns in the meeting next week around inflation. That revision in payrolls, which was really overshadowed by by Oracle and the assassination in the States this week, I think will definitely weigh on the Fed board, as well as obviously political pressure and a lot of Fed governors are being investigated. Trump's digging for dirt. That's a hell of a lot of pressure, and it's still up in the air whether the Fed member. But Trump is trying to get out. As Lisa Cook, will even be there. So they're trying to escalate that to the Supreme Court as much as possible, as quickly as possible. Let's have a quick look here. The Aussie market, pretty much flat for the week, to be honest. We don't have a lot of tech in our index, so that really does weigh us down a touch. Unfortunately, iron ore sort of failed a little bit yesterday. Sort of had high hopes there, for it to break out to the upside through 801 a ton. So I think that's probably the next step for the Aussie market is to have that, those iron ore miners drag it up, because the tech sector is just not quite big enough here in Australia. All of these technical signals now flashing strong buys for the Dow, the S&P, the Nasdaq, and the Russell on rate cut expectations. So I dare say we would be at 100% just about, or 99% for a 25 based on the CME rate watch tool. I had a bit of a quick look this morning. It's around about the 15, maybe somewhere between 15 to 20% for a 50 basis point cut. I think that coming in at 2.9, which is pretty close to the top end of the band for inflation numbers. And look, the Fed generally does use PCE rather than in the CPI and PPI numbers. The CPI and PPI numbers, the Bureau of Labour and Statistics has got a really bad habit of just, if things get expensive, they just take it out. And it's very much weighted to rents and things like that. So, and probably an overly high weighting for consumer electronics, which by their very nature, if you're going to compare them, are deflationary because they're comparing performance like for like. If a new version comes out, that's not, that's more expensive. That's not compared to the old version. It's the old version compared to the old version. So, we've seen examples, and they're fairly anecdotal, all over social media about how much meat and groceries and things have gone through the roof, and power costs, etc. But it doesn't seem to filter into the numbers anywhere near as much. And then the PCE numbers is the personal consumption, so it's the income versus the prices, which is a better measure of inflation, in my opinion as well. So Asia's done pretty well this week as well. Alibaba's had a pretty awesome week there. I think that's probably helped drive up China A50, but there's not a lot of news out of Asia this week. We have had long end bond yields go up in Japan, but Japan tends to march at the beat of its own drum. So and Euro stocks up a little bit this week, despite there being riots in France. We've got a few clients currently over there at the moment. They're talking about buses being rolled over, tear gas, as they're being tourists around France, and in two particular areas that are fairly far away from each other. We've both had fairly fairly frightening experiences overall. So, and you've got that vote of no confidence that went through for the French Prime Minister. And there's a few decisions to be made there, but that bank, the outgoing government in Japan as well, the Prime Minister stepped down. That could see rate hikes later in the year. But again, turmoil geopolitically, really, but none of this is remotely being focused on here at the moment. But I mean, what's been tending to happen over the last few years is the news flow is, and you could see that in the payrolls revision at the start of the week. That revision came in an hour later. Oracle's results came out, and the payrolls thing, I know I've been talking about a bit, just dropped clean off the news cycle within an hour. And all we've been talking about is that Oracle result and hyperscaling AI, et cetera, and then obviously a slight bit of positivity around these inflation numbers not being very high. Again, as probably anyone who's watched my morning broadcast regularly, I think these numbers are suspiciously convenient to get rates down, and they've all happened post the commissioner or Labor and Statistics Commissioner being fired in the last 6 weeks. EJ Antoni hasn't been confirmed to replace them there, but I think that Trump sent a very clear message to the BLS and the head honchos at the statistics department that he needs weaker jobs numbers and inflation better not be high. He keeps saying that there's no inflation, and he keeps using the example that egg prices have come down. So, yeah, if that's your measure of inflation, I suppose he's right. If the numbers don't suit your argument, just change the numbers. I've written an article on that before and around about 6 weeks ago, and this is exactly what's happening now. So apart from that political pressure he's putting on the Fed with Lisa Cook being fired, and that's been contested, he's trying to escalate to the Supreme Court as quickly as possible because he obviously appointed a lot of – he was very lucky to have some – positions become available for him to appoint when he was in power last time. So the quicker he gets things to the Supreme Court, the quicker she just gets her thing thrown out. And so he does have that power there. But there has been reports of various investigations into the personal lives and finances of a lot of the Fed members. I would not be surprised, and I'm normally not a rate cut advocate. I think all we're doing is kicking the problem down kicking the can down the road for the problem. I would not be surprised if we get a 50 basis point cut next in the next week. That'll be Thursday morning, about 4 a.m. our time, and then the press conference around 4:20 a.m. So then the market will shut about an hour and a half later. We shut at 6 a.m. That's Sydney time. But overall, we're at fresh record highs, and the positivity news flow keeps going. So what will end up happening, going back to my earlier point, is when the news flow is positive, we find positivity in everything. And where these negative news stories are sort of stacking up, in the background, you really won't see investors or the market or the media start to focus on those until the market turns around. So all of these things I've been talking about, like the labour revisions, the high valuations, the Salesforce flagging that their major corporate customers are reducing their AI spend, no one will be talking about them now. If the market does pivot and head lower, then realistically, you'll see the reverse flood, and all those stories will all of a sudden become important again. So, look, as I do a lot of media, bearish doesn't sell, and outlining the risks doesn't sell. So unless it's like Chicken Little mode where the sky's falling, bearish doesn't. Bearish is just not a thing for that the media loves to run with. So and I'm often criticised for being too bearish. My view on that is I like to outline the risks to people so they know what they're getting themselves into. I'm very well aware that this thing rallies 97% of the time, but I think you're a much better investor being aware of the risks. You don't have to position yourself for the risks all the time. Very much just just flagging that things can go wrong every now and then. Worked very well for us in April. Saved clients a lot of money and bought very well. And we're doing the same here again, where we're returning to cash. We've returned to cash, and we're only sitting in our high conviction themes. So Oracle and Broadcom having a little bit of a pullback overnight. But look, those two stocks, I mean, Oracle's up 40% in the last, since the start of September. I dare say Broadcom's probably up 20 to 30. So to be ignore those two because they're absolutely on fire. Micron was up 7.5% last night, upgraded by Citigroup yet again. So Oracle, Micron, and Broadcom, AVGO. I know, very confusing ticker code. All recommendations of MPC in various forms. So Oracle and Google are in our hyperscaling AI structured investment, which is leveraged 6 times, which is doing unbelievably at the moment. That was we struck on that on the 1st of September. I think Google's up about 16% and Oracle's up 38. So, that's a 2-year strategy there. And then Broadcom's a high conviction. Tesla also one of our high conviction. And look, Tesla, I had it on the call yesterday on Ausbiz TV. I honestly think you want to be buying that while everyone hates Elon, because it is cheap. It's not a car company anymore. They're going to be selling full self-driving car software and robotics and God knows what. So I think the question yesterday was comparing it to BYD. I don't think that's not the investment thesis for Tesla anymore. They don't sell. They're not selling passenger cars. They're selling self-driving cars, and the data around that very likely they're so far ahead in the self-driving that and all the other manufacturers are just going to have to buy Elon's software. So yeah, but look, very green here. This cyclical part here for in the banks, particularly very very strong. I agree with JP Morgan and Goldman Sachs that you probably want to be selling into this rate cut. I think now we've been calling rate cuts, or anywhere between 70 to 99% for rate cuts for well over a month now. 50, the move after a 50 basis point cut, because 50 is classified as an emergency cut, is usually not good. Historically, when we've done 50, it's been for very horrible reasons in the economy. But this plan from, in my mind, this plan from Trump for the numbers to be poor, probably for about the next, 5 to 6 months, and getting those rates down, he needs them down about 2%. It's about $500 billion in interest costs a year he can potentially save himself. Some may say that's for the greater good of the US economy, and some may say it's manipulation. Whatever your opinion, it's not, that's not none of my business. I'm just trying to relay the reality of the situation. Is that in his mind, he thinks he's doing the country a favour by potentially manipulating figures, because the outcome of rates 2% lower for the national debt, which is very close to being mathematically impossible to deal with, is a higher priority than the integrity of the labour numbers. And I'm probably of the leaning that maybe potentially he's right. So but he'll have to scare the Fed into it, and that's what seems to have happened over the last since the Statistics Commission has been fired. Central bank bonanza next week. Really nothing much to bother even speaking of in terms of earnings. Industrial production will be important for the materials sector on Monday in Australia. RBA Assistant Governor speaks Tuesday. Don't know how much will be out of that. I think we'll be very much focused on the Fed. Retail sales, will probably take a back seat. Normally it would be watched because we come into Wednesday night. We got the Bank of Canada meeting Wednesday night. Then we're into FOMC Thursday morning, Aussie employment Thursday day, Bank of England meeting Thursday night, Bank of Japan meeting Friday. That's a pretty heavy, and each of those central banks have their own unique issues. So the economists will be pretty busy, and well, I dare say we'll have a fairly quiet run into that FOMC meeting. I'd be selling into any rate cut. I'd be selling into a 50 or a 25. I think the run's already happened now for the equity market, and I don't confirm if we get 25. I honestly think the US equity market will be bitterly disappointed. So really, we've had gold and silver and copper and platinum drift higher over the course of the week. Look, US dollars down 0.32 overnight, nearly down 1% for the week. That's more. These moves here are more weakness in the US dollar than they are anything fundamental about precious metals. Crude's dropped off a little, down 1% for the week. I don't know really what's happening in coal here at the moment. It's been a fairly horrible week for coal. It did have an okay run recently, but it's now back to $100. So, there's no real news around that. Uranium, yet again, just outstanding. Lithium, the heat's come out of lithium now because of that CATL announcement that they're going to start resuming. So that's really belted the lithium stocks here in Australia. I feel for you lithium bros out there. It's been a rough 18 months, I've got to say. Uranium, though, I think copper, the COPEX ETF, or is the same thing as wire in Australia, is at 52-week or record highs. Uranium ETF record highs. Again, plays into that hyperscaling and rapid expansion of data centers. And that should be pretty good for the likes of BHP, which has a lot of uranium and a lot of copper. So I think Australia today, realistically, we might be a little bit risk off. Again, we tend to err on the side of caution, and there's no real catalyst. I think everyone will be just preparing for next week. So, for those of you who don't know about it, our weekly podcast with myself and Jonathan Takadina will be this afternoon. Will be released this evening or this afternoon. Available on YouTube, Spotify, Apple, etc. A little bit of an in-depth look into the markets over the course of this week, and a fair bit's gone on. So you can tune into that if you like what you hear on the morning broadcast here at the moment. Other than that, guys, have a great weekend, and we'll speak again on Monday. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.